I'm Jenny LaPointe with PNWP, Associates of RSVP, and today I have Eric Gray here again from Fairway Mortgage. Now, I bet have all been thinking about lately, with 26 million people filing for unemployment, are your goals of being a homeowner this year for 2020 still on the table and still attainable if you've applied for unemployment? Or what if you're self-employed and you've also gone that route, or taken the route of applying for the PPP? How is this going to affect your buying power, or if you're even going to still be able to be a homeowner this year, since it's affecting such a huge number of people? With this being Eric's wheelhouse and him having all the details on this topic, I'm going to turn it over to him and he can let you know if your 2020 home buying goals will still be able to come true this year. Take it away, Eric.
Jenny, thanks for putting this together to allow us to broadcast out to the community and help them navigate these unprecedented times. It's unfortunate a lot of people have been impacted. I think your question and how you prompted it, fielding a lot of those calls. I'm walking a lot of people through that were in the process of searching for a home pre-COVID, let's say, or now that are in the middle of maybe being impacted by COVID and either having a reduction in work or being unemployed, unfortunately, just coaching them through that to kind of understand their options, probabilities, and whatnot. I think we'll just start at the higher level and then we'll work down the funnel based on different scenarios and case studies, just to give people examples and ideas and whatnot. Unequivocally, just to make this very black and white, I mean, you have to be employed to be able to be qualifiable for a home loan. If you're currently unemployed, you just need to take a TV time out until hopefully we get past the furlough near-term impact on your job and you get back to work. That applies to W-2 or employed people that are, through corporations and whatnot, restaurants, etc. That gets a little gray on the self-employment side. We'll come back and we'll talk about self-employed people after we get through. What I'm talking about is people that receive paychecks from employers at this point. Then I think naturally the next question comes to, well, what happens when I do go back to work? What does that look like? When can I start the home shopping process? What is my qualifying income going to look like? What I'm advising all clients right now is, you really need to be back to work at least a month, right? You need to establish a couple paychecks to make sure there's continuity, right? To make sure that we can establish, as much as how much you make is obviously super important, it's also the history, because we're trying to measure what is the ultimate rule of the ability to repay. We got to make sure obviously you make enough income, but it's just as much the track record of you being back and having stable employment and it being within the same industry. If you use just those two things right there, just know if you're currently unemployed or furloughed, you got to get back for a month. We've got to kind of revisit doing the requalification process and making sure your income's back up to speed and refreshing docs. I will add that just be prepared. If you're coming off of unemployment, there's probably going to be extra letters of explanation to understand the gap. Just prompting everybody in terms of setting expectations that there'll probably be extra documentation. I'm going to go to the next layer here of still the employed people, because depending on your situation, depends on how you're going to be impacted by the unemployment. If you're coming back off unemployment and you're previously were a salaried position and you've restarted that process and you've come back as a salaried position, we should be able to use that income as your qualifying income. So let's say you made $5,000 per month and it's salaried, irrespective of the amount of hours that you work, we'll be able to use that $5,000. As we switch over to the more variable types of income, let's think hourly, commission, and bonus. That's where you start getting impacted by, we really have to look at what your hours are post-unemployment. Are they the same previous to before you were furloughed? And then we also actually, this isn't new and this isn't different because of the current crisis and employment impact, but we also look back 2 years. And so we'll look at your 2-year earnings history to understand what your gross income was, just because it's variable. And so on the variable side, obviously hours can get cut. You can have more hours, you can have OT. That'll be an important piece that we'll look at, and we'll redo the numbers. If you do come back and we don't see the demand pick up like we did prior to COVID and you're working half the hours, just know that we probably won't be able to use what was your hourly rate or your total earnings prior to COVID. I think a lot of people naturally, like on the hourly side, when they get a huge pay raise and a huge bump, that let's say they're making 25% more in current day world, they think we'll be able to use that for qualifying income. But on these variable types of income, we actually have to use year-to-date average, plus we have to look back. So you don't get full credit, I guess, for those earnings, if that makes sense. You can see it really gets down to a case-by-case basis. The grand scheme of things, glass is half full. And literally a month out of coming off of unemployment and being furloughed, we'll be able to restart up the process. And you'll be able to be out with Jenny, and you'll be able to be out looking at houses. As long as you're confident right in your position and you continue to move forward, you'll be able to make that next step into home ownership. Another question I'm seeing is, can I use the unemployment checks that I'm getting through the unemployment department at the Washington State or the PPP as part of my qualifying income? The short answer is no. We would only be able to use that if that was a consistent source of income due to seasonality. Okay. So I'll give you an example, like a crabber. A crabber that goes up and he works in Alaska for what is the fishing season. Every summer he comes back and he gets laid off and then he files for unemployment. And so he's demonstrated that cyclicality in the unemployment, that he's collected those benefits because that's how his job is structured. That's really the only time we would be able to use those unemployment benefits and that income as part of the income calculation. So in this case, apples and oranges. This is a non-reoccurring event. And so it's a great backstop to help you pay bills and make sure life can carry forward, put food on the table. But from a qualifying standpoint on mortgage, we won't be able to use that unemployment income. Are there any other questions, Jenny, on the employed worker income calculation and when can we use it before I move over to self-employment?
That was my question for the employed people going forward, so they could understand if they bounce back off the unemployment and still have the same job sitting there waiting for them with the same pay. Okay, I just need a month of showing this pay again, and then I can reapply to get approved for a home. But if it gets cut in half, then it's going to factor in what their previous 2 past years of pay is, affecting it going forward, and maybe their buying power will be less.
Yeah, you have to think of it. Another piece of this puzzle is the income on these variable income types, let's say commission, the income declining, or is it at trend from the previous 2 years or increasing? I mean, this may be a really good example where, let's say, a car salesman has been impacted and been out of work for 6 weeks. And so obviously he hasn't had any income coming in because no commissions. So he could absolutely start this process up a month after he's back. And let's say he sold a couple cars and whatnot. And we went and pulled his income and looked at the total picture, year to date and looking 2 years back. His year to date may show declining income. So let's say his 2-year average was $100,000, and year to date he's on track to make $50,000. And the reality is that's because of the 6 to 8 week period where he couldn't collect any income. Here's the reality: we're only going to be able to use $50,000, right, for his qualifying income, his gross, that we would break up monthly. Since it's declining, we've got to take the lesser of the two. That's where I'm here to kind of help everybody kind of walk through that. I don't want to be discouraging. I want to be real.
Yeah.
What I would say is very situational, and you don't know until you kind of invest some time and energy into it to really understand post-COVID what your true buying power, qualification, probability is. That's where I would just exercise. You just need to retouch base with your lender if you were in that process prior to getting furloughed, or if you're looking to start up the process. Obviously, that's something we would cover in the qualification process to understand what we could take and then put a game plan together from there.
Let me ask you this. Basically, what you just explained, summarized, is if I'm a car lot guy and I have had, my past 2 years, 100 average, and then this year during disaster, I file unemployment for 3 months out of the year. Now you're only going to go off of my gross revenue for 9 months instead of the 12.
Correct. Yeah. Or let's say fast forward, it's November, we would do year to date average of his earnings. And so it would be 11 months divided by his gross earnings.
Okay.
If that's declining,
Yeah.
if that's less, if that trend is less than his 100,000 that he's averaged the previous 2 years, we have to take that lower number.
Gotcha.
He's probably 100% confident when the calendar turns 2021 and he can see it picking up, right? And he's already back to his normal numbers in November that he was post or pre-COVID. We still have to take that lesser average.
Gotcha. And so then that just applies as well for the PPPs.
Yeah. And so a lot of that, the variable calculations of what is hourly, OT, bonus, commission base goes over to the other side on self-employment, where it's a 2-year average. And then we look at the year-to-date trend, to make sure it's on par. And if it's less than the 2-year average, we have to take the lower income, right? What I would add is the PPP, to your point, that's not accessible, obviously, to regular employees. It's kind of like unemployment, right? So we wouldn't be able to use that because obviously that's a non-recurring source of income and windfall. We just have to fall back on what is your current profit and loss. And even now, for self-employment people, the unemployment insurance pool has been opened up to them as well. The same rule applies, unfortunately. We can't use that income from a qualifying standpoint because we're trying to project and forecast if you have enough sufficient recurring income to make what is that housing payment and all your other liabilities for the purchase.
Yeah, with your debt to DTI and all that.
Exactly. You got it.
Then I guess my next thing that we could dive into is what type of buyer incentives are on the table still. Pre-COVID, there were lots of first-time home buyer incentives or closing or help with down payment, since that's one of the number one things first-time home buyers need assistance with is saving for that down payment. And I know some of those are based on requirements of the location of the home or how much income you make. And if you're below a certain amount for that income to even receive those benefits, is there any on the table still? And are there still some available for people right now?
Really good questions. From a 30,000 foot level, they're all available.
Okay.
Right? The question is the lender you're working with still originating those loans?
Okay.
I'll give you an example. So the Washington State Housing Finance Commission, fantastic commission that helps first-time home buyers and down payment assistance within Washington State. They're still going. They haven't pulled back on any of their programs. But what I can tell you is from a lender perspective, they've all approached it from a different tolerance of risk, right, in terms of offering those programs. And so I think when we last got together a couple of weeks ago, I think I articulated that Fairway Mortgage specifically was on hold. Like we were not originating those till the dust settled. And ironically, it's so funny. I just got off our company call at 11 o'clock our time. Starting on Monday, we're opening those back up.
Woohoo!
So that's fantastic. It's kind of a yeah, but there's some overlays that have come with it. We talked about credit box, right? Tightening. So guidelines getting a little bit more stringent. And so, for example, whereas before we could do FHA loans down to a 580 FICO score, that's been bumped up on purchases up to 640. When we circle back to these down payment assistance programs, we'll call it the Home Advantage through Washington State Housing Finance Commission. It used to be a 640 FICO score. We personally, Fairway, has bumped it up to 700.
Okay.
Oh, that's our own company overlay. Okay. So Washington State Housing Finance Commission, if you do find a lender that's still doing down to 640, they'll still accept it. The takeaway is they're still rolling and they're still there to help home buyers. They're still putting on classes. I think most of them obviously have gone virtual, Zoom meetings, the 5-hour class. The nice thing is we can originate them now. Just be ready. It just may be a little bit tighter. There may be a little bit more maneuvering on the borrower side to position yourself to be able to qualify for that program. But in terms of how much is available, like the 4% down payment, like none of that has been restricted. It's just restriction on being able to qualify for the loans. So the benefit is still there. We just have to navigate through the guidelines a little bit more.
Okay, that's good to know. And that's ironic that it happened this morning that you got that.
It's crazy. The other thing I would say to everybody else, from a purchase standpoint, just to kind of reiterate, on FHA, you can do as little as 3.5% down. On the conventional side, you can do as little as 3% down if you're a first-time home buyer. Still programs set out there to help minimizing the resources or the down payment you need to make that next step. And none of that has tightened up or pulled back. it's all been on the FICO scores for the most part, right? It's still very robust in terms of the product offerings.
Cool. Well, is there anything else you wanted to touch on real quick before we wrap it up?
Other than, what we just covered, which I think is a ton of information, I would just underscore, and you can probably vouch for this better than I, that we're seeing a lot of good activity in the market and stuff is rebounding. I'm already hearing from my network, the right properties, we're already seeing multiple offers. Activity is really starting to heat up again. And if there's any concern about being on the fence, health of the housing market, I think that's very valid. Right? I still think it's really early in terms of COVID, economy, impact on the housing market. It's better to see green shoots, right, than gloom and doom and stuff. It's kind of slowly, but surely we'll kind of just see how that plays out. And it'll still continue to be a week-to-week process.
Totally. And I've heard some people summarize it when people are on the fence about this and, oh, are we going to hit recession and should I wait to buy when home prices are devalued? But a lot of people basically have a saying where they're like, this is a health crisis, not a housing crisis.
Exactly. The underlying fundamentals going into this are record low delinquencies, homeowners sitting on more equity than they have on record. To your point, the fundamentals of the housing market were very strong and secure, whereas 0809, it was very fragile. And it was as a result of, bad lending practices and people getting loans that really couldn't do the ability to repay and make those payments. And then it was kind of a house of cards that started unraveling with the delinquencies, the foreclosures that impacted housing prices, et cetera.
Definitely. And I'll just add that, Washington State in general, when it comes to us going through recessions or hiccups or financial crunches, we kind of tend to bounce back a little bit because of what our economic demographic kind of encumbers and how it affects us different than maybe California. They don't bounce back as well as we do. Our housing market is a little bit more protected, I feel, than others if for some reason it does happen in the future.
I mean, we've got a strong economy and a great diversified base between technology, manufacturing, biopharmaceuticals. I mean, the list goes on. And so we've got Fortune 500 companies dotted around the metro area and stuff. And so that all just kind of contributes, right, to the health of the housing market. Definitely glass half full.
Definitely. I just wanted to thank everyone for joining us. We hope we answered some questions that may be burning on your minds for if you're going to be able to get that home that you planned for 2020. It sounds like it's still on the table. It's still obtainable. You just need to make sure when you get off unemployment, you give yourself that month time frame to be able to bounce back. If you're an employee, you're self-employed, get your net earnings for that year up. You can go off of a good number for that to have more buying power.